Another flawless introduction. How you doing, friends? This is 0 days to expiration, and it is a new week, Monday, January 9th, and it's the final hour of the market. And we've had a very, very interesting final hour, or leading up to the final hour. So what was most interesting is, well, what I'm going to do is I'm going to recap what the trade was that we took today, why we took it, and then what happened in the market, and then how that might influence tomorrow. So this is the end part. Yesterday, during our retrospective, I felt that we should go long. We should be bullish. And it was because of this growing sentiment that was in the market. Basically, the narrative went something like this. All of the Fed governors and the media and analysts, everybody now is starting to talk about or notice that inflation seems to be waning. Now, I think that the way they measure it might be a little suspect, but that's been their general feeling. And because of that, and also looking at the Fed Watch tool and how the market now is looking at projecting what the Fed is likely to do on the next meeting, which would be first, they're likely to do 25 basis point hike, which is very different from before. You know, the last one was 50, and then several of them before that was 75 basis points. And then there's the idea that maybe down the road that we may see no hike at all, so that the Fed can see that all kind of bake in, intimating that there is some kind of soft landing coming and perhaps a pivot, etc. Now, Jerome Powell is set to speak tomorrow morning before the market opens at 9 o'clock. So given that as a setup, the market is anticipating, or was anticipating, that Jerome Powell may have something in his speech that, will be a slight change or a slight, tilt in his tenor, maybe a little softer. And if that were the case, then the market wanted to front run that by pushing it up going into that speech, sort of getting ahead of it. Because, the market doesn't like surprises. They want to feel like they're already there. And so that's exactly what happened. That was my thesis last night and also this morning, and the reason why we went into a trade long today, which was all, seemed perfectly reasonable. And we got in long just as the market opened. And in fact, you could have got in long earlier too if you were in the futures. And then the market did go up. It went up fairly strong all the way up through the day until about, now let me just explain a little bit, first of all. At around 1:30, I guess, around 1:30 is where it all kind of fell apart. Now, let me explain a little bit about the nature of the market, and I'm going to do a little bit of technical analysis and how I anticipated things to go. So we'll go to the charts. All right, so the green arrow is something that I drew in yesterday saying, hey, we're going up. Now, this morning, we had a sharp move up in the futures and then at the market open. The market opened right here. And when you see a sharp move up like that, there's usually one of two patterns that take place. And I drew this other line here to indicate part of my anticipation on one of those patterns. So typically, when you have a sharp move up like that, there's a little bit of grinding, and then there's always some kind of pullback. And then on that pullback, it usually then recovers and then moves on with the upward move, grinding up into the close. The other possibility is that it comes down and then it kind of weakens and then usually then roll over. Now, it looked like that's exactly what was going to happen, that it was going to weaken and then roll over. But then it accelerated all of a sudden and came down really hard right here. And the reason why that happened was San Francisco Fed Governor Mary Daly came out with some comments. And I think there were some other Fed governors that more or less agreed with that or backed it up or added some more context to that. And she basically said, well, let's see, why don't we do this? Let's take a look at the news article that I found. And, there's lots of news articles about this, but we'll take a look at what she said. Bring this over here, and we'll zoom in on this a little bit. So the headline is, Daly sees interest rates rising above 5%. Okay, so that's not any big surprise. No big surprise there. Well, right now we're sitting at what, 4.5 to 4.75%, or is it 4.25 to 4.5? Let's check that out just so that we know exactly where we stand here. So what I'm going to look at is the Fed Watch tool. Now, this is something everybody should know about. All right, so we're currently at 4.25 to 4.5. Now, she's saying we're going to go to 5 or above. So in order to get to 5 or above, that means we'd need at least 3/4 or 75 basis point hike from here. Now, is that all going to happen first? Because the market is pricing in something much lower. You can see right here, there's an 80% chance. This is the bond market basically pricing in based on their votes. The bond market is pricing in an 80% chance of a 25 basis point hike. That only gets us to 4.5 to 4.75. That's still a full 50 basis points away from 5%. So if on first they're pricing in for a quarter or a 25 basis point hike, that does not comport with what Mary Daly is saying here, where she says that we have to get interest rates above 5%. So what that is clearly indicating is that there's going to be either a bigger rate hike tomorrow, first, or there's going to be several more rate hikes going into the later parts of the winter and into the spring and possibly into the summer. And the market doesn't want to hear that. They definitely don't want to hear that. And so really that is the quandary here. What is going to happen? And more importantly now, market now is taking a look at or anticipating what Fed Chairman Powell, Uncle Jerry, is going to say tomorrow morning at 9. And so now their hopes for rainbows and unicorns have all been squashed. He punched that rainbow and that unicorn in the face, much like I punched Bob in the face. We'll get to Bob in just a bit. And so what should we expect tomorrow? Should we expect more hawkish talk from Fed Chairman Powell tomorrow morning? That is the question. And just high is the Federal Reserve looking to take this. Now, Mary Daly is, for all intents and purposes, one of the more moderate, maybe a slightly dovish Fed governor, where Bullitt is very hawkish. Now, he's also changed his tune where he's, at least in the recent past, has been talking about being a little bit more dovish. So it's almost like good cop, bad cop. You don't really know which is speaking the truth or where they're coming from. You know what their character is, and then they're getting out of character. So it's really a quandary. It's putting the market back on its heels. Now, there's only a 20% base, I guess you could call this a 20% chance that we'll get to half a point hike or 50 basis points. Now, the interesting thing is that I expected this to change somewhat after Mary Daly made her pronouncement or whatever talk that she was giving somewhere. But things haven't changed. This is exactly the way it looked yesterday. Maybe it will take a little while for this to update, or maybe it only updates on, I don't know how often it updates. That's the thing. Maybe it's only on a daily basis. We'll find out. We'll find out by the end of the day whether or not this changes at all. I assume that this is more or less real time, or maybe every half hour or something. Who knows? All right, so that's what happened. This is the market starting to roll over, but then accelerating once her ideas came out. And then there was a little bit of a pause, wondering if it was for real, and then it just kept on going down. So that's where we stand right now. And we're actually lower. Let's see, are we lower? Here's where the market opened. So the market opened, at least from a futures point of view, here's where it closed on Friday. It gapped up a little bit. So we're still above the open. But I feel like if we break this by the end of the day, there's a good chance that we can fall even lower into the evening and into the morning and before Fed speaks. Now, in the same way that the market wanted to get ahead or front run the Fed and Jerome Powell by moving up, here they want to front run and get ahead on the dive. So now, where they were anticipating some sort of crack in this hawkishness, now they're looking for a reaffirmation of the hawkishness. And so now the market's going down. So that's where we stand. And we took a bullish trade. And so that bullish trade is now defunct. Now, the great thing about the way we trade, now let's get me back here. Let's get the big head back. And before I go on, I am just itching to do this, so I have to do it now. That's Bitcoin Bob back there. Hold on. Bitcoin Bob. All right. I feel better now. Bitcoin Bob got his block knocked off. And I'll give him a sound beating later on for you. If you want to know more about how Bitcoin Bob gets beatings, just go to my YouTube channel and look for Beating Up Bitcoin Bob. Anyways. All right. So I feel better now. Man, he's probably cold. We'll be back at you, Bob. All right. The market, I don't know. I think the market has a good chance of moving down pretty sharply. Friday, we moved up very strong. And Friday was kind of all part of this new narrative that was developing. This more of soft landing, perhaps a pivot, some cracks in the Fed talk. And that continued on to this morning, and it kept on going up. And now, bammo, it's just been smashed right back down. So that's where we're at right now. Now, as far as our trade goes, because we trade with asymmetric returns or asymmetric risk, that means that we take very tiny risk looking for outsized profits, typically somewhere on the order of a 1-to-9 risk to reward ratio. Our trade, if it goes bad like this one did, it's of no real consequence. We just move on to the next trade. And we decided not to do what we call a Batman trade, where we play both sides of the trade because of the apparent, the bullish sentiment in the market. And so we saved any kind of risk that we took on that other trade. Although had we put on the Batman trade, now that I think of it, that would have been a better way to go, because we might have profited, to tell you the truth. So I got to think about that one. Had we put the Batman trade on? No, I don't think so, because we would be now sitting right between the two trades and maybe have doubled the risk. So I think all in all, what we did was the right thing to do. All right. So, okay. So that's the state of the market. That's the state of our trade. And so where do we go from here? I think that tomorrow Jerome Powell is going to come out and he's going to be a little bit more bearish. He needs to talk down this market somehow. I know it's just such a dark place to be that the Fed governor is trying to talk down the market, that I don't know, is it right for him to think that, or to hope that the market starts laying more people off? I mean, huge layoffs have been announced. It just doesn't seem right. I mean, it's antithetical to what their primary directive is all about. Yet they think that that's what, it seems to me, now tell me if I'm wrong here. It would seem to me that instead of laying people off and putting people out of work, and that is the way that you want to control demand, it would make a lot more sense to me if you could make the public more employed and more productive, if you could increase their productivity, maybe by, lowering taxes or incentives, whatever. That also would have the effect of lowering prices, because if we're more productive and we're more cost effective, then naturally it costs less than to make products. And so prices should be stabilized. They won't be going up. That to me, that makes more sense. And that's a way of looking at it. I just don't understand how the Fed thinks that by cutting jobs, that's going to cut demand. I mean, what we really need is people to be more productive and then take the money that they earn and start saving it instead of spending it. That's where the incentive should be. Incentive on saving. That would make a lot more sense. That would truly address the inflation problem, and it would be better for everybody. Why go down this dark road of punishing people to try to make or to fix your own mistakes, I guess is really what it comes down to. All right. So that's, you got to wonder sometimes. All right. Anyways, if you like what you're seeing now, give me a thumbs up. If you're not subscribed already, hit the subscription button. That would be like right about here. This little 0DT thingy, press that, subscribe, click on the little bell notification, and then you'll be informed every time that we come out with a new video. The second half of the program, I'm going to start talking about sizing and profit management and how we go about that. And so, but before I do that, we'll do a little Q&A here, and we'll do a roll call and see who's online right now. So let's see, we got Brent. How you doing, Brent? Hey now. And JMO Jones is here. Jonas here. Nice to see you. And Jay Hen, fancy intro. I'm working on the intro. I still have, I need to come up with bumper music and some better music in the beginning, but it's going to get better. I mean, at least you'll have a good intro, right? Instead of, the failures that you have during the show. Jay Hawk says, hey everyone, finally able to make it to the afternoon stream. I'm glad to hear that. And JD, good day. How do you feel about at the Money Iron Fly with about 15 minutes before the close? So we try an at the money Iron Fly, 15 minutes? No, not in this market. There is one case that I can make for that. And it doesn't even have to be an iron fly. I don't know why it would make a difference if it's an iron fly or just a long or short, a long fly, either a put or a call. But at the money, you're going to get the worst risk to reward. So if if the market decides to move one way or another, as it's known to do right near the close, tends to move in the last 5 or 10 minutes, then you're going to experience a max loss, and that's going to hurt. If you want to put on a very large or wide fly, that's going to put yourself at tremendous risk. The risk to reward is going to be asymmetrical, but it's going to be in the opposite direction that you want to be in. Now, one thing to do, and we've done this before, is to do what we call the Pegasaurus trade. And that's where you take a bunch of very narrow flies, maybe a 5-wide fly, and put them every 10 or 15 points on either side of the market. And then when you're right near the end, the profit curve is already well developed. And if it does move one way or the other, you can capture it as it moves through the fly. That might make some sense, and we might try something like that. And we've tried final hour trades. As a matter of fact, if you go back and look at my video lineup, the live stream lineup, we did an experiment with final hour trades and tried all kinds of different things. 100 trades. And although the first 50 were, they went fairly well, the second 50 were just totally flat. And so we just dropped that whole idea. It was just too much risk. It was too difficult to manage. However, recently I've been fooling around with this, quote, the Pegasaurus trade, where you have a bunch of small little flies, just like sticking up like this, right? And then try to capture the move through there, or if it lands on one of them, there's a fairly good possibility it could land in the middle of one. Because then the risk to reward is very good, especially if you put it a little bit out of the money. That is a possibility. But what you're talking about at the money, absolutely no way. No at the money. Because even with a 5-wide, I don't think that you can get the right risk to reward. But put it a little offset, 5 or 1 or 2 strikes out of the money, you can get a very good risk to reward for a 5-wide. Bitcoin Bob looks like the old Slam Man. I'm not familiar with the old Slam Man is. Maybe you can enlighten me. Jonah says, what would have been the bear trade if we did a Batman? Well, it would have been a mirror trade of the bullish trade. So generally, when we put on a trade, it's a 1-to-9 risk to reward ratio if we're putting on just one. If we put on 2, then the other one goes 1-to-9 just on the other side. Pretty simple. Interesting. Robro, was up, Stephen? No, I do not want that job. Ernie for Fed Chairman. I do not want that job. I do not. Because I don't know, there's to be the brightest people on the planet that are working at the Fed, all of these PhD level economists, they have 300 of them or more that are all doing all of these calculations and analysis and everything. And man, they do a job. And I don't know if they're more run by data or politics. They say that they're not political. They say they're not affiliated with any party, but that's not what they show. It's not what they show at all. And that just seems like such a dirty job. It would feel like when you were younger, or maybe now, if you worked in a restaurant, a big restaurant, and let's say you were a waiter or a busboy or whatever, and you're in and out of the kitchen, at the end of the night, you had this kind of patina of grease and restaurant smell all over you. That's kind of like how I would feel going to work at the Fed every day, that I would have this patina, this grease, this smuck just all over me every day after I left. I couldn't take it. All right. Yoto, I hope that I pronounced that correctly. I put a butterfly for 38.70, 38.80. Okay, a 10-wide fly at 38.80, betting it's pinning for 38.80. Risk $60. So that's not bad. $60 on a 10-wide, that's better than a 1-to-9 risk to reward ratio. Much better, as a matter of fact. And max profit, $9.20. It's actually more than $9.20, but I guess when you consider the cost of the trade too. But a 10-wide with 60 cents, the max profit is $940. And then the cost of the trade is about $8. So it's really about $930. But it's not that bad of a trade. I like it. I mean, that's a good risk to take, in my view. And put it on just a few minutes ago. Well, good luck to you. Good luck. All right. So we've done our roll call. We went through the Q&A. Give those thumbs up. Where are they? I don't see that many. Come on. Get off your butt. Press that thumbs up. Thank you very much. And now it's on to the next segment where we're going to talk about, this is all going to be revolving around the course. I'm giving a free online course. I'm not giving you the preview to it. And we're talking about the various subject matter. And then there's going to be a free course that is going to mirror everything that I'm saying here on the website. And next week, I'll have the link and the first part of that course all done. And that will be for you. You'll have it forever. You'll learn all about our classic out of the money butterfly 0 DTE trade, and how I've shown that you can make 4 to 7% per month in any market. Actually, you can do that in a bear market. In a bull market like we had last year, it makes substantially more. So hang on, I'll be right back. And now we're going to go to intermission. While I set up. All right, there's only so much of that we need. I feel like Bob needs another hit. All right, so where we left off last time with the course was entry rules and then also how you take profit. Now, the entry rules on our butterfly are relatively simple, and it's all based on asymmetric risk to reward, asymmetric returns. And so we found that the sweet spot in asymmetry, after hundreds and hundreds of trades, we found that it's right around 8.8, 9, 9.5, right around there. 9, that's the risk to reward. So if you were to look at any particular butterfly, the easiest way to get a 1 to 9 would be to look at the width of the fly and then make it cost 1/10 the width. So if you had a 20 wide fly, then it should cost $2. If it was 30 wide, it should cost $3. Now, how far out of the money is that? Inconsequential. Sometimes it will look like it's way far out of the money, and sometimes it will look like it's much closer to the money, and it will be the market really pricing that in for you. So there's no real thinking that you have to do there. You don't have to say, well, you always put it like three strikes out of the money. But that's just the wrong way to go, because if you did that, sometimes you would have an outrageous risk to reward, and other times it would look okay. So instead, we have found that sticking to the risk to reward formula gives you more consistency over the long term. So that's the first step. So let me just review that. Entry rules. And, these rules are, like I said, born out of hundreds and hundreds of trades and what works. Over the past couple of years in a bull market, this has produced anywhere from 10 to 25% return per month. And in the bear market, it still did well, producing anywhere from 3 to 7% per month. So pretty simple. We like to have the wider the better. I found that 15 to 30 wide. If you're using the XSP, then it would be between 2 and 4 wide, because the SP is 1/10 the size of the EX. And this would also apply for the E-mini S&P, even though in reality, it's half the size of the EX. Still, I would even say that, I would prefer to say that should be 20 to 30 wide. That's better. Or maybe even 20 to 35 wide. There you go. Like I said, these aren't rules. These are more suggestions. But I'm just going by what the data says. Now, this thing here, which way do you go? So if you're just trading the single classic out of the money symmetrical butterfly, do you go bullish or do you go bearish? And a lot of times we really don't know. When I was first developing this strategy, I would often say that you have to develop a directional bias. You have to do all of this macroeconomic analysis and try to figure out which way the market's going, and then put, your fly on that side of the market. Now, last year, that was an easy thing to do. And it had nothing, it mostly went bullish, because last year everything went up. And occasionally you had a pullback, and then you'd go bearish, and then you go bullish. So when the bear market started at the beginning of this year in January, I tried that same methodology and it just wasn't working. Last year, making anywhere from, 10 to 25% return a month, it seemed like you could throw crap against the wall and it would stick, and everything was cool, and then the wall would clean itself. But this year, completely different story. And what I found was, where last year I had anywhere from a 65 to a 95% win rate, month to month, because the market just went in one direction. This year, the win rate, with all of that work and all of that effort to try to figure out my market bias or my directional bias, still only about a 53% win rate. So what that was telling me is that it's all crap, right? It doesn't matter. So, but obviously, if you can be a little bit over 50%, that would be great. But the reality is that you could have a win rate as low as 35% and still have a good return. When you get up to the 50, 55, or even 60% win rate, this starts, shooting off into the stratosphere in terms of return. So if you can just do 50% win rate, you're really ahead of the game. So my advice would be to just use something in your basket of tricks where you think whether you should be bullish or bearish that day. And probably the easiest way to do this is to maybe look at a 50-day EMA on maybe an hour chart. And then when it's above there, go bullish. When it's below there, go bearish. I guess, It, quite frankly, even if it goes against you that day, because you have such small risk, it's not going to hurt you. And often when it goes against, it then comes back and you end up profiting anyway. So that's what I would do. That's how little I think, I used to think that developing your directional bias was absolute. Now, I guess it is if you're in a bullish market. But then the same rule would apply, right? If you're above the 50-day EMA, go bullish. If you're below, go bearish. And if you're above it, put on a long call fly. If you're below it, put on a long put fly. Again, that doesn't make that much difference. However, if you get too far out of the money and you're on the wrong side with a put and a call, then your pricing may be a little wonky. So if you're bullish, use a call fly. If you're bearish, use a put fly. Always choose a 1-to-9 risk to reward. Very important. And use this simple formula, just 1/10 of the width is your debit. And that will serve you well. All right. Let's see. I have a tool somewhere that shows all of this. Hold on. Right. So what I'm showing here is just a table that kind of illustrates the green area is where you want to be for these trades. And if you're a little bit off, it's not a big deal. If you're at a 1 to 8.5 as opposed to a 9.0 exactly, because you can't always dictate exactly what you're going to get for a debit. So we use this to just sort of help us along there. Right. The other thing that I want to show is that what we're really going after is this distribution of returns. And what this is a skewed right, long-tailed distribution of returns. And this methodology is what this actually provides. And this will provide you with that nice, smooth equity curve, bottom left, top right. All right, let's go back to the presentation and talk a little bit about once you're in the trade. Like I said, getting into the trade is pretty easy. Take that 1-to-9 risk to reward. You're in the trade. You're at a price. You're fine. And now what you need to do is figure out when to get out. Now, ideally, you would like it or love it if the market moved and ended up right in the center of your butterfly and ended the day there, because then you would have what's called a pin trade and you would have made the maximum profit. Now, if it goes in the exact opposite direction, chances are you're going to get 100% loss, but because it's small. Remember, it's that 1-to-9 risk to reward. If you put on a trade that's, say, 10 wide, that's $1,000 potential profit minus the 1/10 minus $100. So it's about $900 potential profit, and you're risking $100 to make $900. If you lose the 100, you lose the 100. If you want to trade smaller, then trade on the E-mini S&P. And instead of going for a $100 risk, you're taking a $50 risk, basically the same thing. 10 wide with a dollar cost. It's at 1/2 of that dollar because the E-mini has a big point value of 50 instead of 100. So that $1 is actually equal to a $50 risk. If you want to trade the XSP, which is the micro version of the EX, now you 1/10 that size. So you have a lot of options to choose. Now, of course, 10 wide is probably, that's really way narrower than I would go realistically. I was just using that to make the math easier. I would rather go 20, 25, 30, 35 wide. So once you're in the trade, that's the easy part. You're in, it's all kind of automatic. Now you have to manage it. If it starts coming in your direction, what do? Well, here's the thing. This is the toughest part of this, and it's the thing that a lot of people struggle with about getting out. Everyone wants to get the pin trade, so they try to hold on to the trade too long, and then they end up outside of the profit tent with a max loss. Instead of when at times during that trade, they could have been 100, 200, even 300% up, and then they give it all up because they didn't end up in the middle of the street. They allowed it to move out, which is crazy because those are profits. Those are real profits, and they're huge profits. And to give it up just doesn't make sense. So you have to have some kind of system and methodology and a way of tracking your performance and your decision making and have a framework that helps you make those decisions. And then that framework should include a continuous improvement process where you're constantly taking a look at how things go and rate yourself and then figure out whether or not you're staying on track with your process and getting back onto that process. And over time, you're going to get better and better and better, and your profits are going to go up and up and up, and you'll know when to take profits and when to not wait around or when to wait around for the biggest score as well. Now, here's like I said, here's the deal with this type of trading. We're dealing with the exponential decay of premium. So not only is the directionality of our trade important. So in other words, delta is important. Where price is moving. Obviously, when it's moving near our butterfly, we want to be near that butterfly. That is definitely important. But it also comes down to timing too, because during that day, your profit curve is continually growing and growing and growing and eventually taking the shape of your butterfly expiration. Now, you need to understand how that growth happens and where you are to the butterfly and whether or not it's a good risk to hang on or a better risk to grab your profit and run. So there's two dimensions to this. There's distance to the butterfly, and then there's time of day. Now, here's something that I want to illustrate to you about time of day and exponential return. Now, we all know, we've all seen this profit curve, and this represents the rate of decay of the extrinsic value or the time value in an options contract as it comes to expiration on that 0 DTE day. Now, 0 DTE on the SPX, those are weekly options. They're 8 days, they start 8 days prior to when they expire. And so each one of these horizontal columns here represents a day. So we have day 1 here on the left, and then the 0 DTE day all the way into the right. And then the red line is the amount of premium that starts on day 1, and then what it ends up with on 0 DTE, which is 0 at the very last second. Now, the interesting thing here is to note just how much it decays over that period of time. So if we were to split this up into threes, like the first 3, right? So the first 3, we're let's see, hard to draw or anything here. So anyways, day 1, day 2, day 3, we'll call that the first section, right? And then day 4, day 5, day 6, that's second section. And then day 7, day 8. Now, I just counted out the whole life cycle of that weekly option and the rate of decay of that curve. But if you were to take just the 0 DTE day, that same rate of decay looks exactly like that on that last day, right? Because it's all now, it's a fractal. And so that last day can also be broken up into 3 different segments, just like I did here. Now, one thing you'll notice is that on the very last day, look how much profit, or how much premium is that decaying in that time period. It's about 1/2 of the total premium throughout that entire time. Well, it's the same thing when you start talking about that last day. Most of the profit and most of the decay happens in that last third of the day. It's actually a little bit less than a third. Because the premium is going exponentially, we make those time periods a little shorter. So we've split the day up into 3 parts, is what I'm saying. So just like we have it over 8 days, let's do this over hours, right? So the first 3 hours we have here, the second 3 hours, and then the last 2 hours. It's the same scale, okay? So that's what we're doing here. We're using the same scale for that last 0 DTE. So that's going to all feed into how we create our framework for taking profits. Because we know that the vast majority of profits are going to, if we were in the right spot, are going to happen in that very final hours of the day. But that doesn't mean that we can't make profit before that either. So, but it's unlikely that we're going to make much in the very beginning, the first 3 hours. Not unusual and not totally out of the question, but less likely. That doesn't mean that you can't take profits then. You certainly can. Because a lot of it will also depend on the nature of or the direction of implied volatility. Because this premium will either get bloated or compressed, depending on whether or not volatility is moving down or moving up, respectively. All right, so let's go back to our framework. So now we have our 0 DTE profit management strategy framework. And so what we do is we break it up into 3 distinct segments. The morning segment, which is that first period of time between 9:30 and 12, first 2.5 hours. And then the afternoon segment, which is from 12 to 2:30, the next 2.5 hours. And then the very last segment, late afternoon, from 2:30 to 4, about an hour and a half, right? So we break that up into 3 segments. And the reason why we're doing that is that for each segment, we'll have a slightly different based on where price is relative to the fly, right? Are we way outside of the fly and in total loss? Or are we right on the edge of the fly, right outside of it, near one of the long legs? Or are we inside the profit tent? And we look at that at both the morning and the early afternoon, same way. And for each one of these, we develop strategy for how we're going to deal with the profit there. Now, generally that strategy, essentially it says it's a trailing stop, in your head type. You look for the highest potential profit or highest profit that you've achieved during that time period, and then you set a trailing stop on it in your head. So for instance, let's say that you're at 100% return on your risk. You might say, okay, in the morning time frame, I have a 75% trailing stop. So if it loses 75%, then I just get out. Right? Maybe that's what it is. If you're inside or near the long leg, let's say I make 150%, and maybe my trailing stop then is 50%. And so if it loses 50%, it goes from $150 down to $75, I get out. It's something like that. Now, I'm not saying that that's what your strategy is. I'm saying that that's how you would develop it. And of course, it would take into more consideration other factors. What is the market like? Is volatility moving up? Is it moving down? Was the news that came out? What is the underlying market structure with the volume profile? Because that may make a big difference if there's an area of support or resistance that might give you more confidence to stay with a trade or not. A lot of things can happen. So you're going to have to develop, and this is basically what your entire trading experience is all about. And that is that every day, you take these trades and you develop a hypothesis for how you're going to handle that situation, and you execute it. If it works well, doesn't work well, works okay, or whatever, and you implement it correctly, then you log it, you journal it, you try to rate it, and then you move on to the next day. And you just keep on doing that. Over time, you're going to have a huge data set of this experimental data and its results on how you approached various strategies, morning, early afternoon, and late afternoon, in these various, and you'll be able to start categorizing them based on the context of the market, your emotional content, your ability to follow your, etc. And then you can then look at those and then see patterns of good behavior, bad behavior, maybe some of those behaviors you recognize that you need to fix. And so you introduce a new habit building exercise that fixes a fault that you had in a particular area that might help you do better, etc. And then you also look at the best trades and then you put them in your playbook, and then you have those categorized so that you over time start building up this, massive playbook with all of these top-notch situations and trades that you could recognize and then refer to so that you can repeat the good behavior and the good results. So that's basically how we do it. Now, that process of doing that's intense. That's what it means to become a professional trader. And next time, what I'm going to do is I'm going to go into a little bit more detail about that process and the playbook and journaling and why we do, what are some of the, the best on how you do that. So that's really what this service is all about. Let's see. Do we have some comments here? So they're all talking back and forth. Let's see. All right, cool. So this service is really all about how to develop that process, how to become a professional trader. And it's not just the profit taking there that you're developing a process. The process extends beyond that. There's a individual trade process. There's a process in your entire trading day. There's a way that you conduct on a daily basis, a weekly basis, a monthly, a quarterly basis. There are things that you need to do to get yourself in tip-top shape, both mentally and physically, so that you can achieve that day. And then things that you need to do to make it easy for you to concentrate on what you're doing day in, day out. How do you clear all of the obstacles in your way so that you can focus on one thing? All of this is what you would be practicing in order to become a professional. And this is what we teach here. This is how we coach. It's how we mentor, how we keep you accountable. So if you're interested in learning how to do that, and using a seed that is super strong, that is proven really. And I'll talk about that also in the future, why this particular strategy and the underlying tenets, the philosophy behind it, is what you should be looking at or favoring, because this strategy has the underpinnings of what virtually all successful traders, professionals, entrepreneurs, venture capitalists, anybody that is looking for peak performance is doing something similar in I guess, at a high level, doing what we're doing here with trading. And that's what we teach. So if you're interested, go down below, click the link, zerodte.com/try. And there's a trial there. You can actually, now I've changed the trial so that originally I said 4 weeks, but now you can do as much as you want. You can do 2 weeks, 3 weeks, 6 weeks, whatever you want. It's still the same thing. And then you decide when you're ready. And if you are, then you can join the service, and then you get the additional benefits of being a full-fledged member. So there you go. That's it. I'm done. Looks like it came in right on time. It's 3:55. Where's the market? I haven't even yet. Let's check this out. It used to go down. So the market now is really setting up. The market right now is setting up for their new anticipation of what Chairman Powell is going to say. So now they're trying to front run. I would suspect right now we're for the day. And it wouldn't surprise me if overnight we drop even further, because this is a very illiquid area here. And if you look closely, you'll see these horizontal lines. The yellow horizontal lines, they represent inflection points that are between value nodes, which is showing that in between these areas, these are very low liquidity areas. So it won't be hard for the market to move through this down to the next LVL, the next line here. So I wouldn't be surprised if tomorrow we're down here at like 38.70 or so. Wouldn't surprise me at all. What happened with Tesla? Tesla gave up some too. Look at that. Had a really, really nice move up today. Of course, I captured all that move, which is good, and held on to it. All right, that's exactly right, Brave Dave. Preparation is vital. Preparation and also performance. You know, both of those things go hand in hand. And let's get the big head back here. You know, everything that we do, if you look at, the little circle here, right here, that circle, that's called a Zen circle. And so that is referring to some of the underlying philosophy that we hold here in the service. And that is kind of we have things in a very objective way, a real way, a realist way. And that is kind of based on, it's not though. We're not like a temple or a religion here, but it is based on Buddhist philosophy and how we approach all of our problems and how we use process and mindfulness to do the things that we need to do. So that's it. I think the market is going to drop right at the lows. Come on, do it. And you should probably know, I am also a practicing Zen Buddhist and Taoist. But that doesn't mean that I can't get my ire up every once in a while and punch the hell out of Bitcoin Bob. So just reading some of the comments here. Yeah, all right. All right, I want to thank everybody for showing up. And for those people in the chat, thank you very much. Make sure you get your thumbs up in there. Really appreciate it. And that's about it. The market is almost here. Should we wait for the close? See what happens? Will we dump in the close, or will the market find a little bit of a fresh breath? I don't think so. I think that overnight we're going to dump, because now we need to front run Jerome Powell, because now we know where the rest of the Fed compatriots are, particularly someone like Mary Daly, who is traditionally a kind of a dove or a dovish. And now she's being a little bit more hawkish. So therefore, Jerome, I'm sure, is back there, rolling them up and getting all psyched for more rate hikes. But what's going to happen February 1st? Man, all right, the close is coming very soon. Where are we? Almost there. 10 more seconds. And that's it. I didn't have the ding, ding, ding. Ding, 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 ding. All right. Thank you. Peace to you all. And we'll see you tomorrow with the next 0 Days to Expiration show. And now, time for the glow music. And one more punch on Bitcoin Bob. That felt good.